South African petrochemicals group Sasol on Monday, in other words today, posted a 27% rise in full-year earnings, boosted by cost cuts and higher oil and product prices, and said it expects a rise in volumes at its synthetic fuel operation this financial year. Headline earnings for the year ended 30 June increased by 27% to 33 Rand and 85 cents per share from a year earlier. Tshepo, let's kick off with you. Sasol, fantastic set of numbers, slightly below expectations in fact, but a new CEO, David Constable, and very energetic and also very optimistic about prospects, particularly within the gas space.
I think rightfully so. I think that's probably where Sasol is going forward. In our mind, it's actually Sasol's a cross between a technology company and an oil company as well. In that a lot of what they do is new technology and introducing new ways of doing things, and that's how they go about generating earnings. So I understand my take from the presentation was that it was mildly optimistic,
yeah.
And I understand that. I think they're very well positioned.
And of course, Craig, a market cap of 205 billion Rand, a PE of around 9.5 and a dividend yield of 4%. It seems that Sasol is one of those favourites, but it is, of course, from a PE valuation perspective, far cheaper than its long-term PE, which is sitting at 12.5, and as I said, sitting at around a PE of around 9.5 to 10. What is your sense with the numbers? Because it's looking quite cheap, but then again, a lot of risks that lie ahead.
Yeah, I think there's some concerns in terms of where the oil price is likely to be, although bearing in mind, Sasol did take quite a knock on the oil side itself, but gas to liquids, synthetic fuels is really what Sasol's all about, and it makes really good margins there regardless of what the oil price, where the oil price goes. So I think that's why it's come off a bit. Of course, the whole market's come off, but what's quite interesting in the results is there's been quite a lot of one-off expenses, about 1.1 billion of them, and you've also had the BEE costs, etc. So if you start stripping these things out, the valuation actually looks really cheap in my view going forward, notwithstanding where the oil price may actually go in the short term.
Interesting, Tshepo. I mean, you said it's not only an oil and gas company, but it's also seen as a technology company, but it tracks the Brent crude price, and also it's quite sensitive to Rand movements. We know that it does have a hedge in for the oil price, and it's quite a big collar of around $85 a barrel, going up to as much as $170 a barrel, so well within the target band that we're looking at right now.
No, for sure. I think in the short term, you could very well see that oil price fluctuating in either direction as we get more and more economic data. But in our view, and we do like taking probably a bit of a long-term view, probably more than most. If you look at the fundamentals that are likely to push up that oil price, a good example that we like to use is that in the States and Japan combined, they have a per capita oil usage of 23 barrels, whereas in India and China combined, they have a per capita oil usage of 2.3 barrels. Now, if you look at the relative sizes of those populations, and I'm not saying that for any moment it's going to go straight to those levels, but I think that starts giving you insights in terms of the potential upside in terms of the oil price or sustainability of oil price going forward. So our view is that looking out forward, commodities as a whole are looking attractive.
No worries about double dip and possible recessions coming to the fore, Tshepo.
Look, these are factors that could very well come to the fore in the next month or two. But again, looking out 2-3 years, I can see a case of oil trading around about where it is or even higher.
And for you, would you say, Craig, that the overall prospects for demand for oil looking quite strong? And we know that there has been a lot of tensions in the Middle East and other geopolitical factors on a global level that have been affecting the oil price, and in fact boosting the oil price. But OPEC actually came out and said that they are starting to downgrade the growth outlook and the demand outlook for oil. So is that one of the big points of consideration going forward? And Sasol, actually one of the best performing stocks in the top 40, only down 0.5% at a time where we saw some stocks shedding over 4%.
Yeah, look, I think the oil is going to be a short-term play, and of course if Sasol does fall, which it may well do in line with the oil price, it's really an opportunity to buy because they're pumping a lot of money into growth plans going forward. We know they've invested in Canada, in some shale projects there as well. They spent about 25 billion in capital expenditure this particular year. So there's a lot going for it up to 2017, 2018, and so with that type of outlook, at these sort of prices, it's worth looking at. Obviously, we do expect some weakness in the oil price over the short term, but the long term, as the gas to liquid projects come, the oil price is not going to be that much of an issue.
Well, let's touch on the shale gas projects actually, Craig. Let's delve into that for a second. We know that the CEO is quite optimistic. We know that those acquisitions have, of course, been concluded. What is your sense? Because you also mentioned that if we do have significant shale gas findings here in South Africa, and we know that is also controversial, that it is of national significance and Sasol would like to play a part in it.
Yeah, I think their technology is certainly something that's unique, and regardless of how actively they're involved or whether they're partnering with other players, which is more likely, Sasol's expertise is an important part of that. It's difficult to speculate because obviously there are quite a lot of environmental issues that are of concern at the moment. But you can see from the announcements coming out from Sasol, they're very concerned about their environment, and they're making that known with things like this shale acquisition. Obviously their stance on it is a bit different to what we're seeing come out of the media.
And of course they've got a 50% stake, as we were alluding to, in Farrell Creek Shale Gas. It's an asset of Talisman Energy within the Canadian markets, and they're starting to actually explore in other areas, Papua New Guinea, the likes of Mozambique and Australia. You know, China's not going that well. We'll go into that in just a bit, but exciting prospects within the shale industry. Really
exciting prospects. I think what I particularly like about, for lack of a better phrase, the style of management thus far is that they are exploring all these opportunities, but aren't really pushing through solutions that aren't working. China, as you touched on, they're looking to scale back in terms of their explorations there. So I think it is exciting times. I think this is an avenue that's got significant upside for them. And as a shareholder, we're very happy in terms of the strategic outlook for
And is China not a concern? Because again, the CEO actually alluded to that the Chinese government really needs to decide, is it coal to liquid, is it gas to liquid? What exactly are they going to be doing from an energy perspective?
It is a concern, as I touched on. I think the sense I get is that they're putting that on hold. I think they spoke about them allocating those resources elsewhere. So from that perspective, I think you've got a world full of opportunities for them, and they're targeting areas which aren't a concern for them immediately. I think long term there's probably opportunities arising from China.
And Craig, as we're talking about China here, it is a market that is very lucrative when you look at the Indian prospects, and we know that they've also just concluded certain studies there, feasibility studies. So again, a very exciting environment. Would you say that they need to go into China if they are going to become an even bigger, significant global player?
Well, I think it presents a fantastic opportunity for them, as does India on the coal to liquid side. Their real strength is obviously on gas to liquids, but they've got the technology there too. So if they can get into China, I think it's going to be a wonderful story going forward.
Okay, so hot or not then for you, Craig?
Yes, absolutely hot. So
you'd be buying it and holding it for the long term at these levels, despite all the risks ahead?
Well, you know, I'm seeing a head and shoulders formation pattern in the market. I'm expecting some weakness. So I'd be looking for bargains, and but even at current prices, it's certainly worth nabbing.
Okay, so Tshepo, what's also fascinating with regards to its hedging strategy, and I mentioned it with the CEO earlier today, he was alluding to the fact that it didn't really have a big impact. They've got that large collar. Would you like them to see embarking on more hedging? Perhaps hedging currency. I have weakened to above 740 actually on the green against the greenback.
Sure. I think that general term hedging at Canon is probably close to being a swear word. I think from our perspective, we'd like to see companies doing and focusing on what generates profits, which is their technology, and letting the market forces be the market forces. So less hedging from our perspective would be better.
Okay, so hot or not for you?
Oh, very hot. I'd be filling my pockets, filling my boots. I think at these...
And this is coming from a value manager, so we are looking at value here.
We are looking at value. I mean, it's trading at a PE, I think, of about 9.5 as at today. So at these sort of valuations, we think it's very attractive.
But why is it still looking so cheap, though? And we have this argument with Anglo American and BHP Billiton as well. If things are looking so fantastic for these companies, I mean, we're sitting in a very lucky position, but why is the market not re-rating these companies?
I think the market outlook is for the next year year and is focusing on what commodity prices, and specifically oil prices, are likely to do in the next year. So really, you're seeing a strong pullback in those counters, not necessarily looking through the cycle, but focusing on short-term data.
Right, let's shift gears now. Looking at technology firm EOH, the company posted a 35% increase in full-year headline earnings per share to 197 cents, while revenue grew by 43% to 2.4 billion rand. The group's growth is attributable to a combination of both organic growth and recent acquisitions. EOH says its growth strategy will continue to be a combination of organic and strategic acquisitions, while major investments will be made in developing the group's offerings in Africa. EOH, with a market cap of 2.1 billion rand, we're looking at a PE of 11.3 and a dividend yield of around 2%. Let's start off with you, Craig. The likes of EOH, and I know that there have been detractors on the show really concerned about the acquisition versus the organic growth scenario that is playing out, but organic growth still accounts for around 60% of overall growth. What is your view?
Well, I hear John King make that statement, but the problem is that it's very difficult to work backwards and see that the organic growth was in that sort of region. For one, nobody's mentioned, and I looked at about 7 or 8 media articles that the previous financials have been restated. So if you look at the growth of the previous financials, your diluted headline earnings per share is only about 22% from 2010 to 2011, and your earnings per share is about 26%, notwithstanding their trading announcement where they're expecting between 30 and 40% growth of the previous number of 154.5 cents or whatever it was. So that concerns me a bit. And if you're looking at 22% growth, and the only acquisition that they've really indicated what the effect on earnings will be was sitting at about 21.7% growth. Yeah. So I can't see that the organic growth was 60%, and that's always been a concern. And again, I can't read that sort of organic growth into the financials in terms of what's been presented.
Craig, are you saying that you really are concerned about the acquisition strategy that EOH has embarked on? Because we know that some have actually said it's a mini-die data, so it could actually fall apart going forward if we just see acquisitions going on and then pushing the share price up. We know this is all just a lot of speculation within the market. Can we comfortably say this, or do you think that's just being far too negative?
Look, it's not speculation. There's a lot of examples. Look, take a very recent example. 1998 was when EOH listed along with Ferritech. Ferritech died last year, and their strategy was very similar. They were in a very similar industry, and there's many examples. We can go back just about every year from IT companies that have grown by acquisition and how it's backfired. The main problem is they're not owning proprietary technology. They're not acquiring trademarks or anything. Their 550 million goodwill on the balance sheet is basically through people. They're offering services, and it's a very fickle business and doesn't always try and get the growth. You can lose big, significant customers overnight. Okay, they have got a big footprint. They claim to have about 2,000 clients. I don't know what that exact spread is in the current numbers, but those are the little things that concern me, and I've seen so often that this strategy eventually runs out of steam, notwithstanding the comments that John King made about a 75 billion rand industry and they've only got a small part of it. There's a lot of people chasing that pie.
Yeah, okay, well, we know that services revenue increased by 66%. We saw software sales increasing by 18%, infrastructure sales rising by 20%. These are fantastic numbers. Tshepo, are you of the same view that the acquisition strategy might be a bit jittery down the line?
Look, I think on the face of it, what you want is, in a perfect scenario, you want a company that exhibits organic growth. But when there is acquisitions, you'd preferably want it to come straight from cash. So the cash funding those acquisitions. I think it's really a function of the price that they've paid for it. And yeah, it's difficult to tell until, I guess, a year or two down the line to see whether this is actually paid off. Their strategy is to go more on the services side. So from a strategic perspective, I think the acquisition made sense. It gives them a bit more access to government, which is what they want. It's actually interesting that that's their strategy, given that a lot of the players in the industry are actually trying to diversify their businesses away from government. So yeah, I think it's one that we'll have to wait and see whether it's actually worked out for them.
And these are big numbers across the period. 130 million rand of TSS managed services that came through, 56 million rand in the likes of the Microsoft infrastructure side of things, Elixir Group as well, 72 million rand. A lot of acquisitions throughout the period. Can they maintain this kind of growth within the acquisition space year and year after?
Look, to their positive, I think it's very difficult to say that we're in a booming IT environment and they are paying exorbitant amounts for all these acquisitions. So I think given the environment that we find ourselves in, it may prove to work out strategically for them. But again, this is, in my mind, this is a company that's proven itself through the cycle. I mean, I think the only time they haven't grown headline earnings per share was in 2004. So through time, they've managed, this management team or series of management teams have managed to do well for the company.
Hot or not for you, Tshepo?
Brilliant company, but within the space we prefer DCT. So not hot. It's a bit rich for us. Through the cycle valuations. Through the cycle PE for us is closer to 29.
So data-centrics for you?
So data-centrics for us.
Okay, so not touching EOH at this stage?
Not at this stage.
Okay, Craig, are you hot on EOH?
Look, directors have been net sellers of the company. Okay, they picked up options at under 3 rand. Share, I don't have any problem with the management of the company and so on, and perhaps the valuations are right. I'm just very concerned. So I wouldn't call the share hot, although many would disagree with me.
Okay, so not hot. What's your preferred play within the sector then, Craig?
Well, I do like data-centrics as well. Right now, I haven't got any additional choice really in the sector.